In this video, we're diving deep into 4 of the most powerful single candlestick patterns every trader must know. At first glance, they might look pretty similar, but don't be fooled. Each one forms under completely different market conditions and tells a very different story about market psychology. I'll show you how to spot them correctly on real charts, explain the secret confirmation rules most traders ignore, and reveal how to tell whether a pattern is actually valid or just noise. We're talking about the hammer, hanging man, shooting star, and inverted hammer. So don't skip ahead. This might just be the clarity you need in your trading journey. Let's get started. Let's start with the hammer. Imagine the market opens at a certain point. Sellers try to take control, pushing the price strongly downward. But suddenly, buyers step in from the bottom, take over, and push the price all the way back up toward the opening. The result? A candle with a small real body at the top and a long lower wick. This is what we call a hammer. Now let's look at it on a real chart. The market is clearly in a downtrend. But as price approaches a key support zone and tries to break below it, buyers step in with strong momentum. A hammer forms right at the bottom, and the market immediately reverses direction upward. That's the power of a correctly placed hammer. But here's the thing. Just spotting a candle that looks like a hammer is not enough. There are 3 golden rules you must check every single time. Rule number 1, the lower wick must be at least 2 times longer than the body. Rule number 2, it must appear at the bottom of a clear downtrend. If it forms in the middle of a range or sideways market, ignore it. Rule number 3, remember the hammer is a bullish reversal pattern. It should be used to anticipate the start of an uptrend, not to trade within chop. Stick to these 3 rules, and you won't fall for fake setups that just look like a hammer but don't behave like one. Now let's move on to the next powerful pattern in this series, the hanging man. This one may look like a hammer, but its meaning is completely different. Let me explain. Imagine the market has been moving upward for a while. Then, at a certain point, sellers enter aggressively and push the price down. But buyers try to regain control and drive the price back up before the candle closes. The result? A candle with a small body at the top and a long lower wick. This is called the hanging man, a bearish reversal candlestick pattern. And here's why it matters. It signals that buying pressure is weakening, and the sellers might be getting ready to take over. Let's look at this on the chart. You can see the market was rising steadily. Then, near a key resistance zone, a hanging man forms. It tells us that, although buyers pushed the price back up, sellers showed strong presence during that candle. And what happens next? Exactly. The market reverses downward. But just spotting this shape isn't enough. Here are the 3 key rules to confirm a valid hanging man. Rule number 1, the lower wick must be at least 2 times longer than the body. That shows strong selling pressure during the session. Rule number 2, it must appear at the top of an uptrend. If it forms in the middle of a range, it's meaningless. Rule number 3, it signals a bearish reversal, which means the trend might shift from bullish to bearish. So next time you see this candle, don't just ignore it. Check the rules. So now we've understood the hammer and the hanging man candlestick patterns. But let me ask you something. Suppose the market is moving downward, and suddenly you spot this candle forming at the bottom of the chart. Now here's the twist. Instead of being green, the candle is red. Would you still consider it a hammer? Most traders hesitate at this point. So let me clear the confusion. The color of the candle does not matter. What matters is where it appears and how it's formed. As we discussed in the 3 golden rules, if that candle appears at the bottom of a downtrend and it has a long lower wick with a small real body near the top, then yes, it's a hammer, even if it's red. So don't let the color throw you off. Focus on the location and structure, not just the shade. Now let's move on to the shooting star and inverted hammer candlestick patterns. Imagine price is rising and reaches a certain point where buyers try to push it higher. But at the top, sellers are waiting, and they push the price back down sharply. As a result, the candle closes near the open, leaving behind a long upper wick. This candlestick is what we call a shooting star. It's a bearish reversal pattern, And when it forms at the top of an uptrend, it often signals that the market is ready to reverse downward. Let's look at this chart. The market is clearly in an uptrend, and as it approaches a key resistance level, a shooting star forms. The candle tries to break higher, but sellers take over and price closes low. And right after that, the market drops. That's the power of a shooting star. But just like the hammer, not every similar-looking candle counts. Rule number 1. The upper wick must be at least 2 times the body size. If not, it's invalid. Rule number 2. It must form at the top of an uptrend, not in a sideways market. Rule number 3. It signals a bearish reversal, meaning price is likely to move downward after this pattern. Finally, the inverted hammer candle. It may look like a shooting star, but it's actually bullish. Let's break it down. Now imagine the market opens at this point. Initially, buyers step in and push the price upward, but as the price reaches higher levels, sellers become active and eventually overpower the buyers, bringing the price back down. The result? You get a candle that looks like a shooting star, but it forms at the bottom of a downtrend. This is called the inverted hammer, and it's a bullish reversal pattern. But to identify it correctly, here are the 3 rules you must remember. 1. The upper wick should be at least 2 times the size of the candle's body. 2. It must form at the bottom of a downtrend, not in the middle or top. 3. Whenever this pattern forms at the bottom, it often signals a reversal from downward to upward movement. If this video hits 500 likes, I'll reveal a powerful Fibonacci secret strategy that most traders never talk about. So smash that like button, and let's unlock the next level together. Now let's understand this visually on the chart. As you can see, the market is in a clear downward move. Price approaches a strong support zone, and suddenly buyers step in. The candle forms a small body near the bottom and a long upper wick, meeting all the rules. This is your inverted hammer. And after it forms, the market shifts direction and starts moving upward. So remember, don't just focus on how the candle looks. Focus on where it forms and how price reacts at that level. So now, you need to observe these candlestick patterns multiple times on live charts. Only then, you'll fully understand them and become confident in reading price action. And since these candles usually form at the top or bottom, that means they appear around support and resistance levels. That's why it's important to know how to draw strong zones properly. For that, you can watch this video right here. If this video gave you value, don't forget to like, subscribe, and hit the bell icon so you never missed our next powerful video.